Hi, welcome to this video on term life insurance policies. My name is Chris, and I'd like to introduce you to our program called LifeHealthExamCoach.com. We have a wonderful program to help agents pass their life and health insurance exams. So please check us out again at LifeHealthExamCoach.com, and we'll show you how we can help. Let's jump into today's topic, which is term life insurance policies. What is term insurance? Well, it's exactly like it sounds. It's life insurance that lasts for a specific amount of time or term. That could be as short as 1 year or as long as 10, 15, 20 years or more. But it's always a defined amount of time. So that's one thing to keep in mind with term insurance. Even though it's life insurance, it may not last your entire life, but it's not permanent. That's another way of saying the same thing. So people need to be aware. You, particularly as an agent, have to be aware of that limitation. What is positive about why do people like term insurance? Well, it's one of the lowest cost forms of insurance. So when I want to have large face amount or death benefits, as they're called, I can afford that probably with term insurance. So it fulfills that particular need. If I need high amount of coverage, then term insurance may be the only way that I could afford it potentially. There's also many different kinds of coverage options for term that we're going to cover in this video. There's level term, decreasing term, increasing term, and then we're also going to cover some of the conversions and renewal options that are available, as well as riders. So let's jump in a little further. All right, there's three main variables when it comes to term insurance. And if you have a good grasp on those, you can really understand all the different ways in which term insurance is offered. It's really just a modification or an adjustment of these three main variables. That is, one, the face amount, also known as the death benefit. So, how much coverage do you want on a person's life? That is the face amount or the death benefit. So, that's one variable, very important one, right? You have to decide how much coverage do I need. Then the second is the term or the time factor, right? How long of a term do I want to cover that for? And that's a decision a person has to make based on what their goals are. And, you know, when it comes to that, it's also going to be the third factor that is a big consideration, which is premium. So all of these factors are interrelated. If I want a higher face amount, I'm going to have to pay more in premium. If I want my coverage to last for a long time over a longer term, that also can mean, potentially a different premium. So as we go in and look at the different ways in which term insurance is offered, keep in mind these three factors or these three variables. It'll help you to understand the different options for term insurance from there. First one that's very common and popular is called level term insurance. And level term is exactly kind of what it says. There's a level um, amount of death benefit over the specific period of time that's selected or the term for that policy. So you can see, we don't have specific numbers in here, but let's say, the death benefit's another word for face amount. Let's say that was $100,000 for a death benefit, and that's a dollar sign on the left. Remember, the premium is a fixed amount that you pay for that death benefit. And I don't know, that's going to depend on that person's issue age. So if you start a level term insurance policy when you're young, say in your 20s, um, obviously it's going to be less expensive than if you start a level term policy, say in your 40s or 50s, because life insurance premiums are based on the risk that the insurance company is taking. And of course, somebody who is older is closer to an average age of death, and so they're a greater risk. Therefore, the premium is higher. And we'll go over that in another training on life insurance premiums. But here, the important concept is that it's a level term policy, means that that death benefit, in this case, we just used the example of $100,000, that stays fixed for the whole amount of the term. So you see the issue age is the time when that policy starts, and the end of the term is however long that term is. And typically you'll see term policies be written for 10-year terms, 15-year terms, or even 20-year terms. And that term then comes to an end. So during that term, it's level because no matter when that person might die during that term, they would receive that full death benefit in this example of $100,000. And they're going to pay that same premium. The premium is also level in this case as well. All right, now here's a unique way of changing those variables we talked about. It's called a decreasing term insurance. And you can see instead of having a straight line at the top, the uh, death benefit is decreasing over time. And again, you see like an issue age, an expiration date, or the end of that term, and that dotted line again is going to be the premium, which most often these policies is also level throughout the time that you have the policy. So what is decreasing term, and why would somebody want a policy that gave you less death benefit as you got older? Well, this is a good kind of product for somebody who wants coverage for covering a specific cost that is decreasing as you pay it off. So either credit, one of the most popular forms or ways in which this is used is in for covering mortgages. So let's say I have a policy out on myself, and my main goal is that if I were to pass away, I'd want to make sure that my spouse could pay off the mortgage that we have together, and maybe have a $300,000 house, whatever the cost of it is. I'm going to start with that death benefit at the beginning of that term when I take out the mortgage. And each year, of course, I'm paying off the mortgage. As I pay it off, it takes less and less to pay off the mortgage, again, in the event that I were to pass away. And my spouse then could, pay it off easily, no matter what time that, I happen to pass away. So why do this? Why do this instead of level term? Because the insurance company is able to offer this at a lower premium than they were if the death benefit were going to stay the same over this period of time. And let's say it's 20 or 30 years. Um, that level term premium is going to be higher. It's going to be higher because you're keeping that uh, death benefit the same over the course of the term. In this case, because I'm reducing it, my overall premium cost is lower. So again, it's a nice way of modifying those factors, modifying those variables to create a product that suits or fulfills a particular need. And that's what you'll see in insurance. All of the different ways of shifting those variables is to adjust to fulfill a customer's specific needs. So here's the opposite of that. We talked about decreasing term. Here you see increasing term insurance. This is probably less common than both level and decreasing term because there's not too many things that you're covering that go up and cause a person to want to have higher coverage later. But there are reasons or rationales for this. Again, because you're starting with a lower amount of death benefit in the earlier of the term and increasing that amount as the term progresses, just like decreasing term, the overall premium for this is going to be lower. It's more cost effective, less cost for the customer to have this sort of coverage than level term. So why might somebody do this? Well, let's say when they're in their early years, they don't feel like they need as much coverage. Maybe they feel also too that it's less costly, so they can afford it better, and they anticipate inflation happening as they get older. They also maybe anticipate that there'll be more bills and more costs. Let's say you have kids, more things you would want to cover as time goes by. So you create an increasing schedule to cover that or to shift things in that way to fulfill those particular needs. Again, all insurance is a sort of cost benefit analysis, and these different ways of shifting the variables help customers have the flexibility to make decisions that are right for them. Renewable term insurance, this is an important feature of term insurance. As we said before, remember, term is happening for a very specific amount of time. So what happens when that time period, that term, comes to an end? If a person has been covered in this way, it's most likely they're going to want to continue to be covered in this way, and they don't want to be excluded or denied coverage. So life insurance can be renewed at end of term with no underwriting, means that once I reach that end of term, I don't have to prove that I'm still insurable. In other words, I don't have to prove that my health is good, and that my risks haven't changed. I can, in a sense, be assured that I can get more coverage. Now, I'm going to pay a higher amount because, of course, I've aged during that time period. So when that new term starts, um, it's going to be at a higher, rate. The example here you see below is called annual renewable term insurance. And in this case, the person is only committing to 1 year of term at a time. And you can see it sort of stair steps up as you get older. The next year is going to be a little more expensive because you're older. And the next year, the premium goes up a little bit. Yeah, you're having that same death benefit. Let's use the same example. Say maybe the person wants $100,000 of coverage. So why would they pick annual renewable term instead of doing just a consistent or longer term like 10 or 20 years? Cost. You remember that cost factor, right? If somebody maybe has less money in the earlier years, the annual renewable term could be a good option. They know they're going to have to pay more each year, but they also figure that maybe their income is going to go up as they get older, so they'd be able to cover that easier by stair stepping up their premium rather than making their premium the same throughout that time period. So again, you're moving those variables around in order to suit the best, the customer's needs in the best possible way. Convertible term is term insurance that can be converted to permanent insurance. And we're going to have another video on whole life and permanent insurance as well that I want you to check out. And we're going to cover everything that you need in order to pass your exam. So being able to convert a policy to permanent insurance is a nice feature on a term policy, because at some point the person might feel like, I don't want to keep doing term insurance, and we'll learn later that permanent insurance has some real benefits as well. So again, somebody's financial situation might change. They might like the option of being able to change their term insurance into permanent insurance at a future point. So convertible term allows for that to happen, again, without any underwriting, meaning without having to prove that my health is still good or that my risks haven't changed, right? So this is a way of assuring that I can still get permanent insurance later, which is, really nice. Okay, term writers. This is an add-on that something can be added on as a benefit to a policy. So all term policies have options for you to dress it up, I guess you could say, cover some things that maybe don't have to do with the main insured on the plan. One of the most common things here is to be able to add your spouse and your children. So you can write a policy for the main insured, and then the term rider enables you to add some coverage there on there for the spouse, rather than having to write a separate policy, and maybe also adding on children as well. So maybe you want to cover final expenses for children should they have that unfortunate situation where your children pass away before the parents do. So this can have a convertible option as well, where you're paying a little bit more in terms of a rider. A rider means this agreement, so maybe I'm paying for that option to make it convertible into permanent insurance. Most term riders do include or have some additional costs attributed to them. Return of premium rider is one that some people find attractive because one of the objections to term insurance is that I'm going to spend this money over the course of this term. And at the end of it, of course, the person doesn't pass away. It's kind of just money spent, which honestly is true with a lot of insurance, right? We have that situation, with like property insurance, your car, home insurance. We have that, and we hold that all the time. And if we don't use it, we're just paying for it. But one of the incentives you can give in the life insurance world for somebody with respect to a term policy is to say, hey, we can write a rider for you to have a return of premium. Obviously, of course, the person doesn't pass away. You're going to pay for this rider. Then at the end of the term, have all those, or most of those premiums returned to you. So that can be very attractive and help that person feel like, oh, there won't be anything lost if I actually live, and we'll have protection in the case that I die. Now, the caveat here, thing to keep in mind is that the return of premium riders can be kind of costly. So the person would have to be willing to pay out more with the understanding the benefit is later they're going to receive that money back. You'll find that's true in most insurance policies. There's a kind of give and take. If you want a certain benefit, there's usually a cost to it. So it's up to you as an agent to sort of weigh those with your customer. What's most important to them? What's going to make them feel the most secure? And utilize these riders and these options accordingly. Okay, let's wrap up what we've learned and go over the sort of pros and cons of term insurance. So I think and hope you've seen some of the pros of term insurance. Very affordable. One of the reasons why people like term insurance, they can cover a high amount. In other words, have a large death benefit at an affordable monthly premium rate. So especially when I have high amounts like mortgages and children's college funds and things that I want to make sure are covered, it's affordable, reasonable to think of having a 100, 200, 300, even $500,000 policy at a premium that I can afford per month. So that's one of the biggest attractions of term insurance is being able to have those large face amounts or death benefits at an affordable rate so that people can feel, covered and comfortable that they have all of their risk covered. So that's one of the main reasons people choose term insurance. It's also fairly easy to understand. We've covered some of the variables there. When you start shifting those variables around, yeah, there's some things there you have to explain, but it's straight death benefit that you're purchasing. So, it's easy to understand from the standpoint, I want life insurance. Here's a policy that's going to cover this much. If I were to die, that's what my beneficiaries receive. And so, it's pretty straightforward from that standpoint. There are flexible options that we've covered here. You can manipulate those variables that we talked about, premium, you can death benefit, and over time, you have some flexibility. Do you want to renew that over 10, 15, 20 years, renew it each year? So there's flexibility. You're not, in a sense, necessarily locked into one particular product for your entire life. And so there's flexibility, and then you can modify that product to meet specific needs, as we discussed. It is renewable, so a person who's concerned, what happens at the end of the term, you can have that renewability feature in there. So covering that concern that people would have, what happens when we get to the end of the term? Can I get another term? I'm willing to pay more in premium since I'm older at that point, but I want to make sure I don't go without insurance. So it's renewable. Convertible, we said it does have an option, maybe again at an extra cost to be convertible to whole life or permanent insurance if a person should choose that option or want to take that exercise that option later on in the course of that policy. And then we covered some rider options. You can add on a spouse, you can add on children. Again, largely pretty affordable to add on those, some of those riders We talked about some riders like return of premium. That could be more expensive, but again, it's an option there. So straightforward kind of policy fits a particular need. That's the benefits of term insurance. What are the downsides? Why doesn't everybody just do term insurance? Well, the biggest one is that it's not permanent. And when you think about getting life insurance, just that word life sort of implies I'm going to be insured all of my life, right? Well, that's not the case with term insurance. In fact, a person might reach a certain age, and actually an age where you're statistically more likely to die, in your 70s, 80s, and beyond, where you've come to the end of that term and maybe becomes like prohibitively expensive to continue that term. Or maybe if you have real longevity, actually outlive all of the options, and then when you die, there's no death benefit. So you've been covered all that time, but there's not necessarily a death benefit at the end. So that's the biggest downside of term insurance, especially if you're looking at uh, insurance or life insurance for the specific purpose of covering final expenses. That's where term insurance, is weak from that standpoint that you could reach the age of your death and find that you're not covered anymore, or that it's gotten too expensive at that point to renew it. So another con is, as we've sort of been talking about, goes along with what we just discussed. There's an increase in premium as you get older, right? So as I just mentioned, that increased cost may not be too bad, in your earlier years, especially if you're doing, short terms like 10 years, from 20 to 30, you're 30 to 40, might not is may be still very affordable for you, but again, as you get into those later years, those increased premiums with age could become prohibitive, cost prohibitive. The other con, some people don't like the fact that it's only got a death benefit. There's no possibility of accumulating any cash value. In other words, the policy is just pure insurance. It doesn't have any other value to it. And because in permanent insurance, which we're going to cover in another video, check out our video on whole life insurance. We'll learn, what are some of the benefits there in terms of cash value. So there are both positives and negatives, to these policies, to term life insurance. I hope this video has helped you to at least understand what the benefits are, understand the structure and how term life insurance works. And please, again, check us out at lifehealthexamcoach.com. We really want to help you pass your life and health insurance exams. So check out our other videos. Thank you.